Welcome to Commercial Real Estate Investing from A to Z, the ultimate guide for real estate investors. I'm your host, Steph Boldrini. We cover everything you need to know from finding and analyzing properties to financing and managing your investments. Tune in every week for expert insights and tips so you can make your commercial real estate investing dreams come true. And in today's episode, we are chatting about ways to decrease your taxes if you are a W-2 employee and if you are a W-2 employee married to someone that is not currently working. We will explain why later, but this is a topic that I have been meaning to share with you guys for a very long time because it's a clear path to decreasing taxes, and it's somebody that I've been asking to come on the podcast for a while as well. We're chatting with Tim Gertz, CPA and partner at Provision Wealth. We're breaking this interview down into 2 episodes. On the next episode, we'll be talking about ways to decrease taxes if you are a business owner and if you are a real estate professional. Here we go. Tim, I am so excited to have you here today, not only because I tried to get you like 3 times, but also because it's a small industry and you have great work ethics, I have heard from people. So I really appreciate that. You will do the right thing always, and that is fantastic. But first, why don't you tell us a little bit about you?
Oh, yes. So thanks for having me. Tim Gertz, as you had said. I've been in public practice for about 22 years now, probably a little bit over than that. Always working in a niche, working with entrepreneurs and high net worth individuals. So my entire career has been focused around proactive planning around that niche market, primarily looking at alternative investments, whether it's oil, gas, real estate has been a huge area of concentration for me. But really working with people that want to control their own destiny. So people that are not looking to just have a W-2 job, put into a 401k and, work until they can retire. We're looking for people that really are trying to make a difference in what they're doing so that they can build or generate their own wealth as efficiently as they want to.
That's awesome. I'm so excited to have you here because tax can be extremely confusing and we all want to reduce our taxes. And there are many different ways to go about it or invest in different things. So I thought it would be a great idea for us to break it down into different scenarios, starting with W-2 employees that are high earners and that are not married. And we'll get into the why they're married later on when we do the married example.
Exactly. A lot of people say, what's the best tax planning advice for, someone that's single and a high W-2, earner? And the joke is get married. But ultimately you are, the tax law is incentivizes you to do things. And ultimately what it's trying to do is incentivize people to grow industry, to create products, to create revenue, create workforce that can ultimately be taxed. So unfortunately, as a W-2 employee, you are in this little box where your opportunities are very minimal. But there are still some opportunities, things to look at, oil and gas investing. If that's the right investment for you, oil and gas could be very advantageous from a tax perspective because it is outside of the material participation rules of the passive activity loss rules. So you can invest in a oil and gas fund and have no involvement in it and be able to offset W-2 income with that investment. It's one of the few carve-outs in Code Section 469 that gives us that opportunity. Another thing to look at, to be aware of, is there's a huge benefit now with the Inflation Reduction Act that was passed in August. It bumped up tax credits for energy efficiency. It reinstated the 30% tax credit for solar on residential properties. It increased the tax credits for vehicles, used vehicles, various energy efficient systems, whether it's HVAC, heat pumps, things of that nature. So those are definitely things that you can look at to ultimately offset taxable income or tax on W-2 taxable income. Additionally, Other little things that you can do, again, W-2 employees really don't have a lot of opportunity. One of the other opportunities, if you are a individual that does itemized deductions, an opportunity might be what they call deduction stacking, especially with charitable contributions. So if you give $10,000 every year, well, maybe instead of giving $10,000 every year, you give 20,000 this year, nothing the next year, 20,000 the next year, and you flip flop between itemized and standard deductions. So that would be another opportunity. It's something that you can look at and see if it makes sense for you. Outside of that, there really isn't much you can do as a W-2 employee, unfortunately.
Can they take advantage of depreciation if they invest in real estate?
They would have to be active in that. So if they have a full-time W-2 job, chances are they'll never be a real estate professional, which would give them the opportunity to take depreciation on real estate.
So I think that's really important to clarify, because a lot of people don't realize that they cannot take advantage of depreciation when they're investing in a syndication, for example, that they're passive, or that they're not a full-time real estate professional. It's really worth highlighting that.
Yeah, I mean, so there's different buckets of income. So there's three real main buckets of income. There's active income, passive income, and portfolio income. Active income is W-2 income, is retirement income, things of that nature. Passive income is just like you said, investing in as an LP in a real estate deal, or investing in someone's car wash and you're passive in that car wash. And then portfolio income is really interest, dividends, capital gains from equities, things of that nature. They don't offset each other. So if you invest in real estate as a passive investor and you have a huge passive loss, you can offset other passive income, but you can't offset ordinary income with that. So they don't commingle with each other. And so that's something to be very aware of as a W-2 employee. You will get a passive loss, but that passive loss will not be able to offset your W-2 income because it's in a different bucket.
So can it offset that investment once the property is sold at that time?
It definitely can. And it can be utilized to offset other passive gains. So in a year when you have a property that sells, if you invest in another investment that has losses from depreciation, the two can't offset each other because they're in that same bucket.
That makes sense. Now let's move on to the example of W-2 employee with a spouse that does not work. And the reason that we're saying the spouse doesn't work is because if both of them have a W-2 job, they would fall under the first example. So in this example, one person has a W-2 job and their spouse does not work. What are the options there?
So ultimately, that opens up a huge opportunity. There's different things that you can utilize the spouse for if the spouse wants to be involved in activities, looking at what is it that they want to do? And, do they want to open a business? Do they want to operate a business? Do they want to invest in real estate and become a real estate professional? But ultimately, one of the nice things about being married is that your income is combined and your income and losses are combined. So if you've got an individual that's a W-2 high net worth or high wage earner, and then you have another individual spouse that is, let's say, a real estate professional, and they invest in real estate that throws off $500,000 of losses every year. Well, now because they are active in real estate, that loss is active. So if we go back to the discussion we had a couple minutes ago, well, now we've got an active loss and we've got active income from W-2 that can marry each other and they will offset each other. So it doesn't necessarily have to be. A lot of times when people talk about this, it's always about real estate professional because that was the industry. That's where a lot of people are investing in. But it could be any activity. It can be any business that someone materially participates. So a lot of times I talk to people about, coin laundry, things of that nature, stuff that is highly capital intensive, that has a lot of equipment on the upfront that can be depreciated, that can create a loss. That will ultimately create an active loss if they're active in it and materially participate in that activity that'll offset the W-2 income.
Well, first, let's explain the definition of a real estate professional, if you don't mind.
Definitely. There's a code section. Everyone talks about it. It's code section 469. It's the passive activity loss rules. That came out of the 1986 Tax Act. And what it did is it ultimately said that if you don't materially participate in an activity, you're passive. And in that, they also lumped rental real estate into a category of being inherently passive no matter what. So now we've got this problem. We've got rental real estate that is passive no matter what. Well, in that tax code, they created a carve out and they said, hey, if you hit these tests, then we're going to allow you to treat that rental real estate as a business. And if you materially participate in that business, then it will be active. And so in order to be a real estate professional for tax, you have to hit two things. You have to hit 750 hours in rental real estate related activities. So ultimately, that's anything dealing with real estate. That can be investing, managing, developing, construction. All of those will give you an hour of work that can add to that 750 hours. So once you hit that hurdle, you hit 750 hours or more in rental real estate related activities, you've hit step one. You hit 750 hours. The next test is you have to do that more than any other income producing activity. So ultimately, you've got 1,000 hours in real estate related activities. Great. If you're a full-time W-2 and you're working 2,000 hours, well, now you're doing that more than you're doing real estate. So yes, you hit the 750, but you didn't hit the second test. So that's really important to know. And so if you've got 750 and you do real estate related activity more than any other income producing activities, well, now in tax speak, you are a real estate professional. And what that really does is it just says, okay, now this activity is a trade or business. And so now we got to look at the trade or business and see if you materially participated in it. In most cases, if you're spending that much time, you've materially participated. And now that real estate, that rental real estate becomes an active trade or business.
And that includes brokers as well, correct?
Yes.
And
yes.
real estate agents.
The only thing it doesn't include is loan brokers, loan originators, things of that nature, mortgage industry.
Okay, awesome. It's really important for people to look at the numbers. Let's say the husband makes $2 million a year and the wife also has a W-2 job. She makes $200K a year. It's a clear thing that she should move to becoming a real estate professional, right? That's pretty obvious. You should look at the math.
Yeah, definitely.
In regards to the taxes that the husband had to pay.
Exactly. And ultimately, a lot of times people are on the fence. So someone is working simply because they think they have to work. And if you run those numbers, and I do that a lot with my client base, is looking at that exact same scenario and saying, does your spouse really like what they're doing? Do they want to do something else? Are they interested in this? Well, yes, they make $100,000 a year. But if we were able to get them into something that they enjoyed doing and they were able to give you a $600,000 loss, that would be more than they're earning on an annual basis, and they'd probably be happier. And that's the most important thing, is to be happy. So definitely.
For sure.
We will continue this interview next week, and we will cover how to reduce taxes for business owners as well as real estate professionals. Tim is also going to be at our conference at the end of the year that we're planning on October 20th. So make sure to subscribe to our newsletter at montecarlorei.com on top of the page. We'll be sending the conference details to all of our subscribers. I really look forward to meeting all of you guys in person in October, and I will see you next time.